Welcome to Centaur Financial Services podcast. The information provided on and made available through this video and podcast does not constitute as financial product advice. The information is of a general nature only and does not take into account your individual objectives, financial situation or needs. It should not be used, relied upon, or treated as a substitute for specific professional advice. We recommend that you obtain your own independent professional advice before making any decision in relation to your particular requirements or circumstances.
Hello and welcome to Centaur Financial Services. I'm Hugh Robertson, this is Nick Georgopoulos, and we just want to give you a quick update of markets, as when we're talking to our clients a lot at our reviews, right now it really seems that it's an ever-changing environment going on in the world based off the fact of what the three kind of big variables have been around what's happening with interest rates, what's happening with inflation, and what's happening with unemployment. So I thought we might kick off there to really just start globally. What are we seeing that's happening with inflation at this point in time?
Yeah, so the inflation still seems to be the number one priority for central banks globally. It's becoming a lot more stickier than originally anticipated, and still up there. So globally, it is starting to slow down a little bit, but not at the rate where a lot of central banks want it to. So they are taking action still in order to suppress that a little bit more.
And so the way that they're taking action is through increasing interest rates
increasing the central cash rate.
So that's been a little bit unexpected. So inflation's been a bit unexpected. It's, if we go back to, a year and a half ago, it was transitory.
Yeah.
Everyone went that once the supply chain gets sorted, inflation will just dissipate.
Yeah.
But it feels that it's been what we now call structural, in that it's here for longer. So the central banks globally have really got to attack it, and the only tool that they've got in their tool belt seems to be interest rates.
Yeah, correct. And we're seeing that most of them are indicating that this could be close to the top of the interest rate hike cycle, if not the top. So obviously a little bit different from country to country. I know New Zealand has indicated that they feel like this is the top for them.
Yes.
However,
and they've just entered into a recession.
Exactly right. So each economy is a little bit different from how they have reacted to those interest rate rises. Here in Australia, surprisingly, last month, June, we rose the rate again.
Yes.
By 0.25, so total cash rate at 4.1% now, which is funny looking back. 12 rises over the last 13 months, and we weren't going to rise until 2024. So a lot of that's caught people off guard. But it's interesting. That in Australia they feel there might be a couple more. 3 of the 4 main banks are expecting a rate rise both in July and August,
yes.
With CBA being the outlier there. But if you look back on their expectations month to month, about 50%, if that are actually correct on their expectations. So it's a tough one.
So we had only 30% of the economists' consensus was that rates would go up last month, and it did. And for the people out there trying to sort of predict what's going to happen, I feel that it makes it very difficult because, we kind of liken central banks to like the school teacher, and we should listen to what they say and we should take their direction. I certainly tell my children that, you need to listen to your teacher. As an investors, we need to listen to, what central banks say. And they've been, because of what's happened with COVID, which was extraordinary, in the stimulus and what they put into the system, we're now still trying to figure out a way through that. And I think from that perspective, central banks get a little bit of, reprieve in that they haven't really known what to do. So right now, just pushing up interest rates at an accelerated rate to really try and stay in control of inflation. And that's the narrative has certainly been by all central banks, that they are going to control inflation.
Yeah.
So that I think that's been interesting from the client perspective, that, this time a year from now, inflation won't be the issue that it is today. And I think when I've seen the top 3 issues for retirees right now is inflation, then going into a recession, and then geopolitical uncertainty.
Yep.
So talk through quickly what is a recession, because if I'm a client and I hear the word recession, we've had some pretty aggressive recessions globally, but a recession really is just 2 quarters in a row of negative growth.
Yeah, that's correct.
So what does that mean? What does that mean for a client out there listening to?
Yeah, correct. So it all comes back to GDP, gross domestic product, basically the growth within the economy. So the income that we're making, the productivity of a nation, if you will. So last quarter, up 0.2%, quarter before that, 0.3%. So it's trending down. It's not negative in Australia, but realistically, the word recession can be a lot more frightening than what it actually is. If we recall, during COVID, we did run into a recession as well, and that bounced back pretty quick. But if we think about the effect of raising interest rates is likely to slow down an economy potentially to the point where we do fall into negative growth.
Yeah. And then that will quite possibly, because it's based off the back of the previous quarter, then if you go into a recession, there's a chance that you're going to get out based off the fact that your number's just not going to be as low as it was.
That's right.
That quarter. I think that's important for the people out there listening to factor that in and saying, okay, a recession isn't necessarily a dire or a bad thing. It's actually what's kind of intended by raising interest rates. We want people to save more and consume less. That's the idea. So we can slow the whole economy down. By virtue of slowing an economy down, you're probably going to go into a recession. I think all sides of government and central banks globally, the goal there is that we have a soft landing rather than a hard landing. And I think most times we're going to be able to engineer a soft landing. I think I heard the Reserve Bank come out this week and said that they would like to see 140,000 people unemployed, more than they have currently. So that's also telling us what's going to happen with the unemployment. So what's happening on the unemployment side of things?
Unemployment side, it's actually going up, which means it's more employed people. 3.5% current unemployment rate. So that's going up, which means the labour market's tight. And if you couple that with increases in wages, so the award wage increased recently by, what's the central, what do they call it?
The Fair Work
Commission, that's it, 5.75% increase on real wages, or the lower wage price there. So it's getting harder for businesses in that regard as well. That's going to have a bit of a wave through the economy as well if costs are starting to increase from the wage side also.
Okay, so this is going to flow through to quite possibly, it's going to hurt, number one, it's going to hurt small business, who's got to pay possibly more, hospitality, things like that, who are already doing it pretty tough. We've got, because of inflation, we've got a high cost of inputs. And now, plus rents, plus wages. But that's also going to go into the big end of town. And so corporates are going to, quite possibly profitability will go down. So, from the client perspective, again, factoring that into our analysis, just say, okay, we really want to make sure we're in businesses that have got the ability to pass those prices on to the consumers to maintain profitability. Through, if we do have a soft landing or a soft recession, that we'll be able to get through that with the portfolio side of things. So with all this worry that's going on in the world, how have shares done, both globally and in Australia, in the past 6 months?
Yeah, well, if we're thinking globally, if we even just look at the US as an example, this recession's been looming over our heads for the last 2 quarters, 6 months now. But S&P 500's gone up about 13% in that time. And then if we're looking more home here, ASX 200, about 3% over the last 6 months as well.
Which is interesting, because if we flip that on its head this time last year, Australian shares were up and US shares were down a lot.
Correct.
And so clients naturally wouldn't have wanted to have been in US shares when they were going down. But that was actually the best performing share class.
Which means it's hard to pick it, right? And that's why we're always continually talking about the need for diversification in portfolios. Other than shares, I think we're in a new way of the world now when we're looking at portfolios where we can bring in more income in there as well.
Okay, so the other negative asset class, apart from global or US shares last year, was fixed income, our government bonds. At some stage, we're down about 12%. Money that's guaranteed by the government. So how's that shaping up now? How's that looking?
Well, it's a different world for the fixed interest asset class. Essentially, if we're talking about bonds, at that time, a reduction in interest rates saw a massive fall in the market. And then the other side, when they raised up again, that's really when we saw that big drop. But that was when interest rates were at 0.1.
Mm-hmm.
Now we're at that cash rate of 4.1%. We've got a sort of high starting point for fixed interest. So when we talk about a risk-free return, basically cash, we're getting a lot more than we ever have in the past. So building that into a portfolio, just starting to make a lot more sense now than it has for quite some time.
So if I see it from a client's perspective, for the last 10 years, when rates were historically low, I've really had to have relied on the capital growth portion of my portfolio, my growth assets, shares and property, to do a lot of the heavy lifting because the income component was so small. But now we're saying that you're going to get about 4% as a risk-free rate. So a government bond, a corporate bond, I might be getting 5 or 6% or even more. And that's just in my defensive portfolio. So I'm a lot less reliant on the growth assets within the portfolio. So even if we do go through this, we just talked about the economy, saying we do go through a recession or some hard times, I'm going to be pretty well sheltered because I'm still going to get a really good dividend or really good rate of interest in my defensive portfolio, plus my blue chip portfolio always getting some dividends.
Yeah, absolutely. Yeah, just by prioritizing income in the portfolio, that's something we haven't done for many years now. Sort of bring up that downside for us.
So in our kind of core balanced portfolio, what are you seeing the total yield, dividend and interest right now?
Right now, we're seeing about 4 to 6% range at the moment, which is quite good.
Mm-hmm. And if we look at the majority of retirees, how much do they draw out of their portfolio?
And it's about the same. It's on average that 5% number is what they're drawing out on an annual basis from their portfolios to live off for their day-to-day needs, their retirement income.
Okay, so it may not be as dire as it if I'm looking at the front page of the papers or I'm watching Sunrise or something like that. It may not be as bad as people are kind of making it out to be right now.
No, but I don't think it ever is, right? There's always going to be opportunities in the market. I think just being quite selective with where you're allocating your money at the moment is important. For the past few years, it has been a very growth-centric market where index, you could really get some great returns. But now that's starting to tilt away, and we have to be a bit more selective of how we put together these portfolios.
And I think something that we've uncovered in our research over the past year is that there are now opportunities that maybe when it was the growth, what we're calling the growth go-go years, we weren't looking at, but strategies now that we can look at that are quite possibly going to give clients some really good downside protection and an income return that's even higher than that sort of 6% mark, which in this environment would be quite attractive.
Absolutely, yeah. It's great.
So if we sort of wrap this up, let's try and wrap this up quickly. Globally, inflation, it feels like inflation's most likely peaked.
Yeah. I feel like that's peaked.
We feel interest rates may have a little bit further to run, but getting close to maybe within 1% of the peak.
Yeah, 1%, and then probably a prolonged wait time before we see that cutting now.
Yep, so that's gone kind of from, everyone was saying the back end of this year, 2023, that might now be.
We're stepping that
2024, 2025.
Higher for longer seems to be the theme at the moment.
Okay, so that way that people are in control of inflation, that doesn't come back up. Unemployment, so what's going to happen there?
Well,
people are going to lose jobs.
People are going to lose jobs.
And that's necessary.
Correct.
Okay, so from the economy point of view, that kind of covers that. From the share market point of view,
Mm-hmm.
On the defensive side of things, we've got to start to really examine that. Something that I know we've talked about is in the defensive bucket, so your fixed interest, please don't look at past returns because they're not going to give you a really true indicator of what your return will be going forward.
Yep.
But it's definitely worth looking at. So talking to people like ourselves about what the opportunities are there, looking at our growth assets, so our shares and property, really trying to look at those businesses that have great recurring earnings, low levels of debt, good management, and are of a good quality so that they can get through. If we do have this economic winter of sorts, they're going to be able to get through that.
Absolutely.
So, and then the number one principle of all investing is to always diversify.
Yep. So
if we do all that, our clients are fine.
It'll be okay.
So there's no need to stress about anything.
Not at all.
Maybe a little bit. Thank you very much for your time listening to us chat about what's going on in the world. I hope you found it useful. And as always, if you've got any questions, please feel free to reach out to us. Thank you.